Ladies and gentlemen, welcome back to the channel. Tesla stock didn't exactly have the best day today, but here in this video, I will explain one, why I'm bullish on Tesla over the next couple of weeks, why I think the markets are delusional, or in other words, delulu, and what we heard today from the Fed that just furthermore solidifies this. Fed Waller said, quote, "I'm a bit more concerned about inflation running softer." Now, markets are, I don't know, lacking of a few brain cells these days, but inflation is a causation, okay? Inflation is a causation of the economy being good or the economy being bad. So when you get inflationary booms, the economy is strong. Okay, so we've seen over the past couple of years, economy was strong, inflation was high. When inflation starts to fall, and as Fed Waller says, actually running less than 1%, if you look at the last 4 months of core PCE and just average in there, shelter inflation running at 2%, you're actually under 1% inflation. You're actually seeing the economy slowing down quickly. And that's essentially what Fed Waller said, but he didn't talk about the economy as much. He said it in terms of inflation, but that's exactly the same thing. If Fed Waller is concerned about inflation running softer, then Fed Waller is concerned about the economy running softer. And this is his validation to support a 50 basis point rate cut in which he voted for. Okay. So Wall Street just doesn't want to accept this fact that the economy is slowing down, and we are seeing this every day in front of us. And part of the reason why Wall Street sent stocks lower today, especially interest rate sensitive or economically sensitive stocks, was part in part due to the comments made by FedEx's CEO. He said industrial demand was softer than expected. Shipments between manufacturers and other companies in that segment are the most profitable for FedEx, which is often seen as a bellwether for the US economy. He said, quote, "The magnitude of the Fed rate cut yesterday signals the weakness of the current environment," which was like a slap in the face to markets, because we're under this assumption that the Fed is honest and we're going to have this soft landing and everything's fine. At the same time, FedEx said, yeah, you seen what the Fed did yesterday? The economy's not fine. And that's what kind of sent markets for a bit of a loop today and what negatively affected Tesla. Now, there was also news that I shared in the last video that Tesla is offering FSD for $4,500 instead of the typical $8,000 on vehicles in inventory. So Tesla is actively doing something to try to run down inventory, which does have some analysts a little concerned that maybe Tesla's inventory numbers are going to come in a little bit higher coming on their earnings. Now, I actually want to switch gears a little bit. I want to share with you something that a little bit of research, I guess, if you will, that I did last night that I guess solidifies just how bad off the economy is. Okay. And I actually took a look at the Fed Beige Book from September of 2022. This is a moment in time the S&P was down 20 or so percent. And proceeded to fall to negative 27%, right? The September Beige Book came out, markets were down about 22%, 23%. And then by early October 2022, you actually hit that low. At this period in time, when this Beige Book came out, Wall Street was expecting a recession. There was a 100% chance of a recession. And again, the S&P had went through a pretty major decline at that point. Okay, so this is the latest Fed Beige Book, how things are right now. And this is the overall economic activity, the national summary. It says economic activity grew slightly in 3 districts, while the number of districts that reported flat or declining activity rose from 5 in the prior period to 9 in the current period. So basically, 65+% of the US economy is declining. Employment levels were steady overall, although there were isolated reports that firms filled only necessary positions, reduced hours and shifts, or lowered overall employment levels through attrition. Still, reports of layoffs remained rare. On balance, wage growth was modest, while increases in non-labor input costs and selling prices ranged from slight to moderate. Consumer spending ticked down in most districts, having generally held steady during the prior month. Auto sales continue to vary by district, while some noted increases in sales and others reported slowing sales because of elevated interest rates and high vehicle prices. Manufacturing activity declined in most districts, and 2 districts noted that these declines were part of ongoing contractions in the sector. Residential construction and real estate activity were mixed, though most districts' reports indicate softer home sales. Likewise, report of commercial construction and real estate activity were mixed. District contacts generally expected economic activity to remain stable or to improve somewhat in the coming months, though contacts in 3 districts anticipated slight declines. Nothing about this Beige Book is good. Okay, most of the economy in declines. Yes, layoffs are rare, but companies are starting the process of reducing hours and trying to reduce their overall labor cost. The only thing that is seen as somewhat positive is generally these contacts expected economic activity to remain stable or to improve somewhat in the coming months, but this has to do with rate cuts. That's all it is. Wall Street's expecting rate cuts, businesses are expecting rate cuts, so presumably you assume things are going to get a little bit better. Now listen to September 2022's Beige Book and let me know what you think about the differences down below in the comments section. So this is the Beige Book from September 7th, 2022. Overall economic activity. Economic activity was unchanged on balance since early July, with 5 districts reporting slight to modest growth in activity and 5 others reported slight to modest softening. Wow. That right there, you're substantially better than the latest Beige Book. But let's continue on. Most districts reported steady consumer spending. That's not what we heard in this latest Beige Book. As households continue to trade down and to shift spending away from discretionary goods and towards food and other essential items. Auto sales remain muted across most districts, reflecting limited inventories and elevated prices. Hospitality and tourism contacts highlighted overall solid leisure travel activity, with some reporting an uptick in business and group travel. Manufacturing activity grew in several districts. It didn't grow in any districts. Okay, in this latest Beige Book. Although there were some reports of declining output as supply chain disruptions and labor shortages continued to hamper production. Despite some reports of strong leasing activity, residential real estate conditions weakened noticeably as home sales fell in all 12 districts and residential construction remained constrained by input shortages. Commercial real estate activity softened, particularly demand for office space. Loan demand was mixed, while financial institutions reported generally strong demand for credit cards and commercial and industrial loans. Residential loan demand was weak amid elevated mortgage interest rates. Non-financial services firms experienced stable to slightly higher demand. Demand for transportation services was mixed, and reports on agriculture conditions across reporting districts varied. While demand for energy products was robust, production remained constrained by supply chain bottlenecks for critical components. The outlook for future economic growth remained generally weak, with contacts noting expectations for future further softening of demand over the next 6 to 12 months. Again, that last part was because we were expecting many more rate increases from the Fed. So of course people were a little bit more cautious or negative on the economy. But this report from, again, the period in time in which stocks were down 27%, Wall Street was pricing in a 100% chance for recession, sounds a lot better than the latest Beige Book that we got. Like, way better, like 10 times better. That is concerning, because Wall Street's just clearly not paying attention to this, but eventually they will be forced to. And by my many videos now warning about these things and pointing out the problems in Wall Street's delusional behaviors is hopefully going to give you more time to prepare for the downside in the markets. Now, I'm not necessarily saying we need to go into a recession or it's guaranteed we're going to go into a recession. I think the odds of a recession are greater than a soft landing. But as markets right now are pricing in a 0% chance of a recession, there's all these different things telling us that perhaps there's a 50% chance of a recession or 40% chance of a recession. If you do have to price that in from 0% to 40 or 50% chance of a recession, you're looking at 20+% downside from current levels. And that's the issue. It's not necessarily recession or not, like you seen in 2022. We never went into a recession. S&P fell 27%. You could get something similar even if we do ultimately avoid a recession. One of the reasons I'm actually bullish on markets in the very near term, like very, very near term, over the next 3 to 4 weeks or so, is because we're on a bit of a sugar high, as I said in the last video, okay? Same thing happened in 2007. The Fed lied to markets in 2007. The Fed said things were okay. We're just trying to get ahead of the weakness that we're starting to see, blah, blah, blah. Like copy and paste the speech in 2007 on September 18th and put that into today. It's going to look about the same, right? The economic data at the time looks about the same as what it does today. Slightly higher unemployment rate, but generally the same kind of economy then as we have now. And markets loved that 50 basis point rate cut. Markets rallied 3 weeks afterwards, in which the S&P went up 6.5%. The NASDAQ went up over 11%. Okay, so from that standpoint, I have no reason to believe we're going to get anything different. The Wall Street wants to hold on to the soft landing narrative, completely disregard any risks or any economic data that we're getting that supports a recessionary environment, not necessarily a recession, but some kind of recessionary, slower growth environment. And I think we're probably going to get the same playbook. Markets go higher for a couple of weeks and then things come crashing down. Now, whether things come crashing down based on earnings that really start in larger numbers about mid-October, whether it'll be after the election when government economic data starts to come in a little bit better, or, you know, who knows exactly what's going to be the root cause of this, but we're at a pretty important level. And I do think the economy is kind of vulnerable here for that shock event. Now, I know a lot of people are going to say in recent years, we've only had recessions based on exogenous events happening. COVID.com bubble, global financial crisis, or great financial crisis. You know, these have been exogenous events over the past 24, 25 years that have caused a recession. I think you are at the moment in time where it's just gonna take one more big event, like another banking crisis, like what we've seen in 2023. If that happened now, that's it. Okay, the economy is not strong enough, and that could be the determining factor whether or not we do actually go into a recession or not, if we do get some kind of larger event. And I do think that's why the Fed is trying to be a little bit more careful right now, not to spook investors, because if markets do fall, if markets do crash, if recession odds do rise, that could be the event, that tipping point to push us into an actual recession. But from that standpoint, I think markets are going higher in the near term. I think we're on a bit of a sugar high, and I think that's why you want to be a little careful here. You really want to be in and out with some of your trades that you're doing, and I think have as much cash as possible on the sidelines. Now, specifically for Tesla, yes, today was not a great day, but you're still trading between this gap level. On the low side, it's about $235 per share. On the high side, it's $246 per share. Whether or not we break above 246 or break under 235 is going to tell us a lot about the trajectory or momentum for Tesla. Right now, things look very good. If we get above 245, 246 or so, then you're starting a run, in my opinion, up to about $300 per share. And it's not going to surprise me if we do run to $300+ per share before October 10th, as you start to get more hype embedded into Tesla around this robotaxi event. Let's face it, right now, I don't think there's really any hype embedded in Tesla for the robotaxi event, but I do think justifiably so, there should be some hype around the robotaxi event. And I think that's coming. Wells Fargo says, don't buy this rally. The fundamentals don't support it. They say the S&P 500 will finish the year at 5,200, warns Wells Fargo. I actually shared this to my X account. It says, finally, someone on Wall Street uses common sense. Like, of course you shouldn't be chasing this rally. It doesn't make sense from especially a risk to reward, perspective. The risk is not an upside surprise to economic activity. The risk is a downside surprise to economic activity, and nobody seems to understand that. And that's why I'm pounding the table, literally pounding the table so hard right now, saying, guys, this makes no sense. You do not want to be on the bad side of what's coming next over the next 3 to 6 months. You want to be prepared for the bad side of the next 3 to 6 months to take advantage of it. It's all in your perspective. It's all in your positioning. You could look at a crash and say, that's terrible. Or you could look at a crash and say, I'm glad markets crashed, right? As maybe sinister as that is, because you could take advantage of it if you can spot these things ahead of time and prepare for them. Now, again, I don't think the markets are going to crash over the next couple of weeks, perhaps until the week or two before the election. Then you could get some election uncertainty, some volatility. But I think it's after the election in November, December, January, February, March of 2025, that 5-month period, that you're really vulnerable here for a larger downside move, like 20-30% downside. And that's when you want to be able to take advantage of that buying opportunity. That's when the Fed's going to cut rates down to close to zero, maybe 1-2%, right? Fed might cut rates to like 2%. And that's when your opportunity is, not just in stocks, but also in real estate, if that's your alley. Take a look at this as well. This has got to be one of the wildest things I've seen in quite a long time. This is 2007, 2008, and this is today. Literally almost identical price action here. Literally almost identical. And if we are right here, right, 2024, markets rallied after the first cut. That's what happened in 2008 as well. You rallied for 3 weeks, and then you started the process of coming down. And it was volatile then, and it'll probably be volatile now, right? For a couple of weeks you fell, a couple of weeks you rallied, and then you really fell, rallied again, and then you really fell heading into the new year. And as you can see here, 2008, the start of the year is when things got much worse. And then by, March and April, that's when things were really starting to get bad for markets on a comparable basis. That would be like going back to early 2024 prices on the S&P, which if you wanted a kind of visual representation of what that would look like on a percentage basis fall, that would be downside of roughly 21 to 25%. If 2008 really does kind of play out the same way on a price action basis. Again, I'm not expecting a deep recession like we've seen in 2008, 2007, 2008. It's possible, but I think we do need an event for that to happen. But simply just looking at these charts, they look almost identical, like literally almost spot on. And if something similar were to happen, you're looking at pretty substantial downside here. But again, not in the very near term. In the very near term, you're going to probably get more upside. Maybe not in the broader S&P, but I do think in other areas that are priced for recession, more like cyclicals and value, dividends, small caps, perhaps Tesla still down almost 50% from all-time highs. Like these areas are pretty well priced for a recession. I think as that soft landing narrative does grow, delusionally so, right? We shouldn't be pricing in a greater chance of a soft landing right now. Things are getting worse. Actively, every day it seems like there's something else that's like, that's bad, okay? But that's not going to stop Wall Street. Okay, Wall Street has its narrative, and it's a soft landing. And with a 50 basis point cut, Tesla stock is going higher in the near term. That's, unfortunate for anyone that wanted to buy the dip in Tesla anytime soon. But if you have patience, I think you will be heavily rewarded for it. But let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.